makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone. Day one. Welcome to The Pulse with me, Francine Lacqua, a brand new show with high-profile guests in the beating heart of global business, economics, finance, and politics. Now, we go wherever the story is, and for our first show, we're here in Sintra, Portugal, for the ECB Forum on Central Banking, where central bank governors, government officials, and financial market experts come together to discuss policy issues and the big economic challenges under one roof. We have Jay Powell, Andrew Bailey, and Christine Lagarde. Now, here's what's coming up on today's program. Monetary policy is in focus as ECB President Christine Lagarde delivers the opening speech at the Central Bank's Forum here in Sintra. We'll bring you her address live, plus interviews throughout the day. Russian betrayal. President Vladimir Putin condemns leaders of the Wagner group as traitors in his first public comments since the aborted mutiny. Plus, Beijing bound. The U.S. Treasury Secretary Janet Yellen will visit China early next month for the first high-level economic talks with her Chinese counterpart. Now, we're expecting Christine Lagarde, who we just saw in the foyer just about 5 minutes ago, actually walking to where she's delivering her keynote speech. It'll be extremely interesting to hear her talk about monetary policy and, of course, the big question that the Fed, the central bank of, well, many countries around the world, including the ECB and the Bank of England, have to ask themselves is that, do you focus on inflation now, or do you wait a little bit to see how much actually of an impact what you've done so far in raising rates will have an impact on the economy and therefore on inflation? Remember, last time we were in Sintra was about 12 months ago, and since then, the ECB, for example, has raised rates by 400 basis points. It's pretty incredible to see the change in the narrative over the last couple of months as well. This is what we're looking at in terms of the markets, the focus firmly not only on euro dollar, but everything we're seeing in between. So let's get that market check up for you if we can. Now, the focus is, of course, on central banks around the world, but stocks are rising overall. European stocks are following really Asian shares higher. We had a raft of data earlier on, and that will continue through the U.S. trading session. Remarks really by the ECB's President Christine Lagarde will be scrutinized by traders who've been growing more anxious as central banks will keep pushing rates higher and risk sending fragile economies into reverse. We did speak to one ECB board official, Mr. Kazaks, Governor Kazaks, who is saying the markets are getting completely wrong what they're trying to do. They will continue, he believes, pushing rate higher until inflation is under control. So this is what else we're looking at. Of course, the focus is on Christine Lagarde. So these are the main stories that we have our attention on today. The other thing, of course, Bloomberg has learned that U.S. Treasury Secretary Janet Yellen is planning to visit Beijing in early July. Now, this is the first time that she's going to engage in talks with her Chinese counterpart, who is a longtime confidant of President Xi. China's Premier Li Qiang has warned governments that removing China from supply chains will only fragment the world. He gave a keynote speech to global business leaders as the U.S. and Europe press ahead with plans to de-risk supply chains.
Some in the West are hyping up the so-called phraseologies of reducing dependencies and de-risking. These two concepts, I would say, are false propositions. Governments and relevant organizations should not overreach themselves, still less overstretch the concept of risk or turn it into an ideological tool. We should oppose the politicization of economic issues and work together to keep global industrial and supply chains stable, smooth, and secure. Without peace, nothing can be achieved. This is a hard lesson humanity has learned from history.
Well, that was the Chinese Premier Li Qiang speaking at the World Economic Forum in Beijing, opposing de-risking by the West. Former President Donald Trump is heard discussing what he calls, quote, secret information that he says he doesn't have the power to declassify in a 2021 audio recording obtained by CNN. Now, reports indicate that the recording includes a moment when Trump appears to indicate that he was holding a document regarding possible military action against Iran. Now, in corporate news, Credit Suisse is to pay a $900,000 fine to settle allegations that it reported debt trades late and misapplied key indicators to hundreds of thousands of transactions. U.S. regulator FINRA says the Swiss bank's brokerage in the U.S. reported about 9,000 trades late during a 7.5-year period up to March this year. Credit Suisse, now part of UBS Group, did not admit or deny the findings and declined to comment. Now, as we are expecting Christine Lagarde to take the center stage here shortly in Sintra, Portugal, for the ECB forum, let's go back to see any moves in euro-dollar. Now, she's just being introduced by Wolfgang Prüssel, so we should be able to listen to her very, very shortly. Look, if you look at what markets are looking at, and I had an interesting conversation with the central bank governor, council member of the ECB, he says traders have misunderstood the resolve of the ECB and other central banks around the world in dealing with inflations. If you look at what's going on in equities today, traders may have finally relented on their bets that the Fed will cut rates this year. This is after Jay Powell last week warned that the U.S. may need 1 or 2 more rate increases in 2023. Now, I think the speech of Christine Lagarde has just been released. This is what usually happens when you're at a big event like this. The speech is released, a lot of reporters will comb through it, and then she'll deliver that speech very shortly. So Christine Lagarde saying they'll continue to raise rates in July. That, I have to say, is probably not breaking news, as the market is fully pricing that in. The question is what happens in September. Christine Lagarde also saying they must avoid expectations of a too rapid policy reversal. She says, and she will say in her delivered remarks, that rates will stay elevated as long as necessary. Now, she says they must make rates sufficiently restrictive. This is a point of tension that we've heard also from Geeta Gopinath, the IMF deputy, that spoke and opened the late dinner last night here at the ECB forum. She says the other thing that we don't spend enough time on is the fact that monetary policy is trying to do one thing, and you have fiscal policy, because of the support in trying to really support the ones that have the least in these economies, that is basically counteracting what we hear from monetary policy. So we'll continue, of course, monitoring that speech. Christine Lagarde should be taking center stage very, very shortly, and we'll hear if she has anything to push back against, for example, some of the rate cut expectations that's being priced into the market. She has also and will say that it is unlikely that the ECB can say soon that the rate peak is reached. There she is, President Lagarde, just starting on stage a couple of meters from where we are. Let's listen in.
Thank you to all of you for being here in Sintra, and those of you joining us online as well. You're missing the wind and a beautiful, beautiful location, I tell you. Inflation in the euro area is too high and is set to remain so for too long. But the nature of the inflation challenge we are facing in the euro area is changing. We are seeing a decline in the inflation rate, headline predominantly, as the shocks that originally drove up inflation wane and our monetary policy actions are transmitted to the economy. But the pass-through of those shocks is still ongoing, making the decline in inflation slower and the inflation process more persistent. This persistence is caused by the fact that inflation is working its way through the economy in phases, as different economic agents try to pass the cost onto each other. Monetary policymakers need to address this dynamic decisively to ensure that it does not lead to self-fulfilling spiral fed by the de-anchoring of inflation expectations. So the key question we face today is, how can we break that persistence? In the ECB's Governing Council, many members of whom are here in this room, we have been clear that 2 elements of our policy stance will be key. And I will quote elements of our monetary policy statement. We will have to bring rates to, I quote, sufficiently restrictive, unquote, levels, and keep them, I quote, for as long as necessary. Both elements are affected by uncertainty about the persistence of inflation and about the strength of of the transmission of monetary policy to inflation. Setting the right level and length will be critical to our monetary policy as we continue our tightening cycle. So in my remarks today, I will explore why the inflation process has become more persistent and what this implies for our policy stance. Disclaimer, typical of a lawyer, some will say. My intention is not to signal any future decisions, but rather to frame the issues that monetary policy will face in the period ahead. So let's look under the skin of inflation. The euro area economy has faced a series of overlapping inflationary shocks since the end of the pandemic. Since the beginning of 2022, these shocks have both raised the price level by 11% and led to us transferring more than 200 billion euros to the rest of the world in the form of a terms of trade tax. In an environment such as this, the natural reaction of every economic agent is to try to pass on these price increases to other actors in the economy. In the euro area, we can identify two distinct phases. The first phase was led by firms, which reacted to steeply rising input costs by defending their margins and passing on the cost increases to consumers. The intensity of this reaction was unusual. During previous terms of trade shocks in the euro area, firms have tended to absorb rising costs in profit margin as slower growth made consumers less willing to tolerate price hikes. But the special conditions that we experienced last year turned this regularity on its head. The sheer scale of input cost growth made it harder for consumers to judge whether price hikes were caused by higher costs or higher profits, fueling a faster and stronger pass-through. As this was not enough, at the same time, pent-up demand in reopening sectors, excess savings, expansionary policies, and supply restrictions brought on by bottlenecks gave firms more scope to test consumer demand with higher prices. For this reason, unit profits contributed around 2/3 to domestic inflation in 2022, whereas in the previous 20 years, the average contribution had been around 1/3. This, in turn, led to the shocks feeding into inflation much more quickly and more forcefully than in the past. This first phase, however, is now starting to wane. Largely thanks to lower energy prices, year-on-year producer price inflation has already dropped by 42 percentage points from its peak last summer. And while it is taking time to feed through to prices more generally, it is partly being reflected in a broad-based decline in headline inflation and a leveling off in some measures of underlying inflation, especially exclusion-based measures and those that capture the persistent effects of energy on economy-wide prices. At the same time, high inflation has eaten into domestic demand, which contracted by 2% over the last 2 quarters, and the consumption impulse created by excess saving is fading. The early effects of our policy tightening are also becoming visible, especially in sectors like manufacturing and construction that are more sensitive to interest rate changes. So faced with this combination, falling input costs and dwindling demand, we saw unit profit growth slow markedly in most sectors in the first quarter of this year. But the second phase of the inflation process is now starting to become stronger. Workers, who are also consumers, have so far lost out from the inflation shock, seeing large real wage decline, which is triggering a sustained wage catch-up process as they try to recover their losses. This is pushing up other measures of underlying inflation that capture more domestic price pressures, particularly measures of wage-sensitive inflation and domestic inflation. And since wage bargaining in many European countries is multi-annual and inertial, this process will naturally play out over several years. In our latest projections, we expect wages to grow by a further 14%, 1-4, between now and the end of 25, in real terms. While this catch-up has long been factored into our inflation outlook, the effect on inflation from rising wages has recently been amplified by lower productivity growth than we had previously projected, which is leading to higher unit labor cost. Alongside past upward surprises, this is a key reason why we recently revised up our projections for core inflation, even though our expectation for wages remained broadly the same. Two features of the current business cycle are contributing to this dynamic, and both could linger too. The first is the resilience of employment relative to GDP growth. Some call it the mystery, not all. Typically, most of us would have expected slowing economic growth over the last year to have somewhat reduced employment growth. But for the last 3 quarters in particular, the labor market has been performing better than an Okun laws-based regularity would suggest. That disconnect partly reflects increased labor hoarding by firms in a context of labor shortages, which is visible in the current gap between total hours worked and average hours worked. And this is weighing on productivity growth. And with unemployment expected to fall slightly further over the projection horizon, the motivation for firms to hoard labor may not subside that quickly. The second feature, in addition to hoarding, contributing to weaker aggregate productivity, is the composition of employment growth, which is concentrated in sectors with structurally low productivity growth. Since the pandemic, employment has grown most in construction and the public sector, both of which have seen a decline in productivity, and in services, which has seen only a meager productivity growth. These trends could also persist in some of these sectors over the next few years, given the relative weakness of manufacturing and long-term shift towards employment in services. All of this means that we will face several years of rising nominal wages with unit labor cost pressures exacerbated by subdued productivity growth. And in this setting, monetary policy must achieve 2 goals. First, we must ensure that inflation expectations remain anchored as the wage catch-up process plays out. While we do not currently see a wage price spiral, or a de-anchoring of expectations, the longer inflation remains above target, the greater such risk becomes. That means that we need to bring inflation back to our 2% medium-term target in a timely manner. Second, for this to happen, we need to ensure that firms absorb rising labor costs in margin. If monetary policy is sufficiently restrictive, the economy can achieve disinflation overall, while real wages recover some of their losses. But this hinges on our policy dampening demand for some time so that firms cannot continue to display the pricing behavior that we have seen recently. Sensitivity analysis by ECB staff underlines the risks we would face if firms try to defend their margins instead. For instance, if firms were to regain 25% of the lost profit margin that our projections foresee, inflation in 25 would be substantially higher than the baseline at almost 3%. So faced with a more persistent inflation process, we need a more persistent policy. One that not only produces sufficient tightening today, but also maintains restrictive conditions until we can be confident that this second phase of the inflation process has been resolved. So what does that imply in policy terms? We have not yet seen the full impact of the cumulative rate hikes that we have decided since last July, 400 basis points. But we know that the job is not done yet. Bearing a material change to our expectations for inflation, we will continue to increase rates in July. And as we move further into restrictive territory, we need to pay close attention to two dimensions of our policy. First, our actions on the level of rates, and second, our communication on future decisions and how that is influencing the expected length of time that rates will remain at that level. The Governing Council has provided orientation on both dimensions. It has stated clearly, and I repeat, that future decisions will ensure that the key ECB interest rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. Two sources of uncertainty affect the level, the desired level and length of our interest rate policies. First, since we face uncertainty about the persistence of inflation, the level at which rates peak will be state contingent. And it will depend on how the economy and various forces that I have described evolve over time. And it will have to be continuously reassessed. Under these conditions, it is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached. And this is why our policy needs to be decided meeting by meeting and has to remain data dependent. Second, we face uncertainty about the strength of monetary policy transmission. The strength of transmission connects current decisions with expectations of future policy and therefore affects the policy stance. How strong transmissions turn out to be in practice will determine the effect of a given rate hike on inflation, and this will be reflected in the expected policy path. Uncertainty about transmission arises from the fact that the euro area has not been through a sustained phase of rate hikes since the mid-2000s and has never seen rates move so fast, so quickly. And this raises the question of how quickly and forcefully monetary policy will be transmitted to firms via interest-sensitive spending and to households via mortgage payments. For firms, ECB analysis finds that monetary policy shocks are typically transmitted more quickly and forcefully to manufacturing, reflecting a sector's higher interest rate sensitivity, while there is more muted and delayed impact in services. The key question really today is whether the services sector will eventually catch down, not catch up, catch down, which is what we have seen in previous cycles, or whether it will be insulated from the effects of policy tightening for longer than in the past, given the strength of demand and employment in the sector. That's for firms. For households, there is evidence that it will take longer for policy changes to pass through to interest burdens in this tightening cycle, as a higher share of households have now fixed rate mortgages than in the mid-2000s. At the same time, once mortgages have been repriced, the restrictive effect may be greater. Gross debt-to-income ratios, which emphasize debt servicing capacity, are higher than in the previous tightening cycles, while the share of homeowners with a mortgage has increased. Both sources of uncertainty will only fade away over time. And that is why we have made our future policy decisions conditional on, first, the inflation outlook, second, the dynamics of underlying inflation, and third, the strength of monetary policy transmission. But to ensure that uncertainty does not interfere with our intended policy stance in terms of both level and length, 2 points are clear. First, we need to bring rates into sufficiently restrictive territory to lock in our policy tightening. We need facts on the ground. Second, we need to communicate clearly that we will stay at those levels for as long as necessary. And this will ensure that hiking rates does not elicit expectations of a too rapid policy reversal and will allow the full impact of our past actions to materialize. And all the while, we need to carefully evaluate the strength of policy transmission in order to avoid an error in calibrating policy in either direction. So in conclusion, it will not surprise you if I say that monetary policy currently has only one goal: to return inflation to our 2% medium-term target in a timely manner. And we are committed to reach this goal, come what may. As the author Helen Keller wrote, our worst foes are not belligerent circumstances, but wavering spirits. We have made significant progress, but faced with a more persistent inflation process, we cannot and we will not waver. Of course, we wish, but we cannot declare victory yet. Thank you very much.
Well, that was the ECB President Christine Lagarde's opening speech here at the ECB Forum in Sintra. Now, what was interesting is, first of all, she didn't mince around. She said, look, we're not done hiking rates. She said very clearly, this was the opening speech here in Sintra, that we need to communicate clearly that we will stay at those levels for as long as necessary. She basically really finished her speech by saying, look, she wishes she could cry victory, but that's not the case yet. So here with me for full analysis and insight is Seth Carpenter. He's Chief Global Economist at Morgan Stanley. Seth, great pleasure to actually listen to the speech together and discover what Christine Lagarde had in store for us, which is the lady's not for turning. They will continue hiking until inflation goes down.
Absolutely. I actually think she highlighted one extra nuance about policy that is going to become one of the key themes in the market. So far in this hiking cycle, markets have debated where is the peak rate, when will they stop hiking? And one point I try to make to our clients is that markets often think in changes. How much are we raising rates? Central banks often think in terms of levels, and so that's why everyone's focused on the peak rate. But President Lagarde also highlighted another key aspect for policy, which is how long rates will be staying at those peak rates. Now, this is a theme that, for example, Federal Reserve Bank President Bostic brought up in recent weeks as well. And I think that's the next frontier in this debate about fighting inflation.
So what do you think the market is getting more wrong? How long, the cuts in next year, do you see them coming from the ECB? Or are they getting wrong, again, the level of hiking that will happen this year?
Well, I think there's still, and I think President Lagarde made this clear, that she was willing to lean into another hike in July, but was uncommitted to what happens after that. We think 375 for the policy rate for the ECB is probably where they get to, with a bit of upside risk from there. I think the market has that part fairly well sussed out. The timing of the cuts, though, I think will be subject to lots of revisions because markets have to price in not just what's intended, but also eventually what happens, including if, for instance, there's a recession.
So, Seth, where do you see the level going in September? Are you expecting them to hike? I mean, we spoke to a couple of central bank governing council members from the ECB, and they say, look, everything's open, but actually, if we look at the data today, it's very likely that we'll see a hike in September.
Yes, so we do think getting to 375 is very much the place for the ECB. I would say right now, policymakers just have to err on the side of saying, we have lots of options are on the table, and we will keep hiking if needed. I don't think they have a chance anytime soon to in any way declare victory.
Okay, what happens after September? Again, I mean, this is a million-dollar question. But if you look at core inflation, and if you look at the biggest concern, which Christine Lagarde was also talking about, which is a spiral, the fact that there's a wage price, pressure that they lose control of, is there less of a chance that monetary policy's mistake is actually hiking too much now?
I think there are risks all over the place. I think in particular with the point about the wage price spiral that President Lagarde seemed to emphasize, I would put that in contrast to a different part of inflation that she also emphasized, which is the margins that we're seeing among firms in terms of how much they can charge customers relative to what their costs are. In the work that we've done at Morgan Stanley, we have tried to ask just how much historically has there been of a pass-through from wages specifically to consumer prices, and it's much smaller than I think most people realize. So I personally am less worried about this wage price spiral.
Okay. Are you worried about the German economy? That seems to be the one thing that people keep on pointing to. We had the IFO numbers yesterday that frankly were pretty ugly.
Absolutely. So there was some slowing. We know in Germany, across the European sector, manufacturing has been hit even harder than services. I think the challenge here is now just the perennial challenge for monetary policy, which is how do you do enough of slowing the economy without tipping over? So I am worried, and I think Germany will be particularly hard hit.
We heard from Gita Gopinath yesterday, the Deputy Managing Director of the IMF, and we heard it there also from Christine Lagarde. They don't know what to do with fiscal policy. So if you have monetary policy increasing rates, but fiscal policy pumping money, I mean, they almost, they're against each other, so they equal it out.
So I think that is always a challenge, forecasting for central bankers. And in general, in my experience, having spent 15 years at a central bank, the answer is usually the central bank just has to take as given what the fiscal authority is doing and then react to that. So the more impetus that comes from fiscal policy, presumably then the more restraint monetary policy needs to provide.
So we also have Jay Powell here. I find it always quite exciting, especially when you say I'm walking actually wearing trainers, sneakers, which we're just not used to, so I had to take a double take. But how hard is it to go against what the Fed is doing? So there's always this gravitational pull out of the U.S. policy that if you're the ECB or the Bank of England, you feel it.
I think there is that tension. One of the ways that tension manifests itself often is through exchange rates, currencies. For now, it seems as if most of the policy rate differential has been reasonably well priced into markets. So I think in that regard, at least for now, each of the central banks has the opportunity to focus very much on domestic issues.
Who has the hardest job? Bank of England?
I would say, yeah. I mean, I think if we look at what just happened with the Bank of England, they eventually people got there, but the 50 basis point hike going back to bigger rate hikes because of this upward surprise in their inflation rates, I think there really is a much more difficult job to be done there. There is some slowing going on in the UK, and yet inflation remains so stubbornly high there. The consumer goods inflation for the UK is actually a bit of an outlier among developed market economies. And so I think in that regard, things are difficult for everyone, but perhaps just a bit more difficult for the Bank of England.
Seth, were they right to hike 50 basis points? I don't know how much this has to do with credibility, right? You can't have that hot inflation number the day before and then just deliver a 25 basis point hike. But is there a danger that the market now, prices that in as kind of the new normal and runs with it?
I mean, I do think that's the debate going on right now in markets, is trying to figure out just how much to price in, and the markets have priced in a peak rate of 6% and at times a bit more. Was it right? Was it wrong? I think that's almost impossible to answer right now. In no small part, last night at dinner, President Lagarde also quoted Kierkegaard saying, "Life has to be lived going forward, but can only be understood in reverse." And I think that's exactly the challenge that central bankers are facing, and in the UK in particular. Now, what happens if markets over-extrapolate? I do think it would be easier for a central bank to tell markets that we're not planning on doing as much if, and only if, the inflation data, the real side data start coming in line with what they expect. So I think for now, it wasn't a mistake. I think it was clear that they needed to show resolve, and then we'll take it from there.
But again, it's the most important thing that, they work in tandem with fiscal policies, because they also have huge, we can't underestimate the impact of housing and mortgages in the UK. So you could see the economy topple quite quickly.
No, it's funny you say we can't underestimate the importance of those factors, and I completely agree. The problem, as I see it, for central banks is that we can only estimate it, and knowing exactly what happens in real time is the challenge. And so how much will that reset of all those mortgages, how much will that weigh on consumer spending? Well, we've got estimates based on historical data, but boy, it's going to be really hard to see how that works out in this immediate post-COVID world.
Seth, tomorrow is the big policy panel. How will Jay Powell navigate that? Is he going to try and say as little as possible?
I don't know that he'll try to say as little as possible. I think his themes recently have been clear, that they are committed to returning inflation to their target. He spent time in his testimony to the U.S. Congress pointing out that the majority, the overwhelming majority of FOMC participants is looking to hike more. And so I think he'll go back to that same messaging of they know what they need to do, they have the resolve to do it. I think it will be interesting on that panel, though. Some of the same questions you're asking me now about who's got it harder, what are the similarities and what are the differences of the challenges different central banks face. I think that's going to be, for me, the most fascinating part of the policy panel.
How many questions do you think they'll field on Russia? Again, we had quite a weekend, right? And we're still trying, frankly, it's just getting weirder and weirder. We're trying to figure out exactly what happened. But if you have an unstable Russia, what does that mean to energy prices? What does it mean to oil? And what does that mean for monetary policy?
I think that's clearly got to be a topic of conversation, either in and of itself or through the channels you mentioned, especially energy prices. President Lagarde highlighted the terms of trade shock that the European economy has faced. I think that's first order important. We got through last winter when everyone was very worried, is the European Union going, Euro area going to have this horrific recession because of a cold winter? And in the event, we skirted that outcome.
It's colder now in Sintra, actually, isn't it?
One could generate wind power here, I can tell you that. No, I mean, I think it's very interesting. I will say our European economics team, led by Jens Eisenschmidt, has done some great work, though, saying that the European economy is actually now, it seems more resilient because we got through last winter. The storage of gas is strong. The ability of the economy to redirect when commodity prices go up is very strong. And so we're actually feeling like that might be one of the very few risks that may have diminished this year relative to last year.
All right, Seth. Thank you so much for coming on. Seth Carpenter, their chief economist at Morgan Stanley. Now, we'll have much more, of course, from Sintra. Still ahead, we talk about the Russian President Vladimir Putin. He blasted the Wagner group as traitors. So we discuss the state of play in Moscow next. And this is The Pulse. So the Wagner mercenary group saga continues. The Russian Defense Ministry saying the group is to hand over heavy weapons to the army. Now, that's after the President Vladimir Putin condemned the group as traitors to Russia. Joining us now is Bloomberg's European correspondent, Maria Tadeo. Maria, good morning. So there are new lines out of Russia involving Wagner and what looks like a possible dissolution. So what do we actually know about this?
Yes, Francine, and I think the term dissolution here may actually be very accurate because at this point, the Russian MOD, the Ministry of Defense, says they have now agreed, and Wagner has agreed, they will transfer their heavy weapons to the Russian army. That is on top of yesterday when President Vladimir Putin said that Wagner members who did not participate in the march to Moscow could either integrate the Russian army or go back home or head to exile, essentially, in Belarus. At this point, the question is, what is a group of mercenaries that do not have troops and do not have weapons? Essentially, what it looks like is this is a Russian MOD making it clear now the Russian army will call the shots. They want the weapons and they want the troops to really understand you either join us or you need to go away.
Maria, we're just also getting really the first comments from the Belarus president, Alexander Lukashenko, saying that, look, the Russian mutiny was painful to watch. What we know is that a business jet belonging to the mutiny's leader, the Wagner mercenary chief Prigozhin, reportedly landed in Belarus, but we actually don't know immediately, or it's not immediately clear who was on that plane. So what do we know about the fate of Prigozhin?
Yes, and that is a key question at this point, because we have seen there is this plane that has allegedly now landed in Minsk. Remember, there was this idea that Lukashenko had cut a deal between Vladimir Putin and Prigozhin so that Prigozhin would head to Belarus and essentially stop creating trouble in Russia. What Vladimir Putin yesterday said, however, without naming Prigozhin by name, is that the masterminds behind this rebellion would be brought to justice. There is some confusion today, however, because the MOD appears to also be saying that the investigation is closed. The key, however, is that we have not seen yet Prigozhin in 48 hours. We have not really seen the man in action. No footage, no pictures. We did we got yesterday, I should say, a voice note, an audio file from the head of Wagner suggesting that he did not intend to topple anyone or overthrow the government, that this was not the goal behind it. But again, a lot of questions as to what Prigozhin and his fate may look like in Belarus.
Yeah, frankly, that was just bizarre hearing him say that he didn't want to try and topple anyone. Maria, thank you so much. Maria Tadeo there in Brussels for us, looking, of course, at the implications of the war in Ukraine longer term. Now, joining us now, I'm delighted to be joined here in Sintra by Guntram Wolff. He's the Chief Executive Officer of the German Council on Foreign Relations, previously of Bruegel. Guntram, it's great to speak to you here. So we're talking monetary policy, but actually we have to figure out what kind of weekend we live through, because it's just bizarre, I have to say. And it's unclear what the steps were and what the consequences of the 72 hours starting on last Thursday were. What implications do you think it has longer term?
Well, look, I think the word bizarre is exactly the right word. We don't know what happened. We don't really know what's behind it. I think there's a lot of uncertainty as regards the longer-term implications. One thing is clear. What happened is what I would call like a black swan. Everybody knows at some stage something big will happen in Russia. Russia is in a mess. Putin has been running the country like a mafia state. There have been the buildup of paramilitary and military mercenary forces. So you give up the monopoly of power, which is always dangerous as a state. And at some stage, depending on how this war goes, you know, the whole thing will perhaps even collapse completely. And so what we've seen here is sort of one puzzle, a piece in the puzzle towards this collapse. So
is Vladimir Putin significantly weakened by what happened at the weekend?
Well, I'm less sure. I think he was weakened certainly on Saturday when the whole thing happened. But it looks now as if he's sort of consolidating power. He's getting back Wagner troops under his control. I think actually he might get out strengthened. I'm not so sure that he would be weakened.
But Guntram, if you expect some kind of black swan event, so Putin losing control or some kind of unstable Russia state, I mean, this is worst case scenario for everyone. So is there anything that the U.S., the European Union, and also China can do now to either stop that or certainly try and contain it?
Well, I mean, that's always the big question. I mean, you want a stable Russia on the one hand, but you don't want a Russia like the one of now that is basically attacking and, killing people around the world. So I do think we will have a period of instability, which is unavoidable. While it happens, we need to be ready to intervene, and I think China should also be ready to intervene. But without, this system breaking down, we will never have a stable European peace order. I
mean, it depends on who and what comes afterwards, right? If you had a President Prigozhin, would he have been more unstable for the world than President Putin?
Well, I mean, that's very difficult to predict. I mean, I think really Putin has been pretty bad, right? I mean, so getting someone worse than Putin for the rest of the world, I mean, it's not an easy task, right? So.
Talk to me a little bit about how Germany fits into all of this. So, economically, it's a very tough time, actually, for German corporates. Does it make it much of a difference to, what happens longer term? Is it confidence, or is it actually what they're seeing in the real economy?
Well, look, Germany has adjusted tremendously last year due to the energy price shock, and it has adjusted politically enormously. I mean, at the beginning of the year, during the fall, it was actually very difficult to convince the German government to deliver weapons to Ukraine. Now Germany has become the third most important deliverer of weapons to Ukraine. The commitment to Ukraine, the Ukrainian security, is by now quite widely shared. So I think a lot has been done, a lot has moved. But having said that, Germany is still in state of denial on how it should work and shape its relation with China in the future. That's the big thing, the big question. German economy is very much interlinked with the Chinese economy. And obviously, it's hard to sort of just give up on that very good economic relation for security reasons. And so at the moment, there's this big debate also among different coalition parties. Who should, how much should we decouple, de-risk from China, and how should we do it?
How's the Chancellor doing? Would Angela Merkel have handled all of this differently? I don't know whether she would have dealt with, we know that they had a personal relationship and she spoke Russian. Would have history gone a different way?
I'm not so sure. I actually do think that Putin really became quite crazy and increasingly crazy, and I don't think Angela Merkel would have changed the course of history here.
When you look at China, we also found out today that actually Janet Yellen is going to Beijing early July. Do you see relations stabilizing between the U.S. and China? Although we're also in an election cycle in the U.S. with so much of it trying to antagonize China to get votes.
Yeah, I mean, I do think the Blinken visit to China was very important. I also do think the Yellen visit is going to be very important. So there is somewhat of a stabilization of the bilateral relations. But look, I mean, China has a long-term vision of the world, and one key issue is going to be Taiwan. And the question is, will at the end of the year, when there is perhaps some uncertainty politically in the U.S., will there be a moment of reckoning where China might decide to move on Taiwan? We don't know. I mean, but that's the kind of events we I think have to all, also as business people, we really have to think about, because if it happens, it's going to be so divisive, it's going to be so difficult to steer, it's going to be really leading to a fragmentation even of parts of the world economy.
So, Guntram, do you think they will? And actually, if they do, does the West have the firepower to counter out this?
Well, I don't know if they will. I think nobody really knows, except perhaps President Xi himself. The West is relatively well prepared, but a lot depends on whether the US and the EU, Europe, can really pull their act together. The US alone is going to be long-term not big enough. I mean, they will need, also in terms of ammunition production, they will need Europe for sure.
Guntram, thank you so much for joining us. Guntram Wolff, the Chief Executive Officer of the German Council on Foreign Relations. Coming up, we'll have plenty more on monetary policy on the back of Christine Lagarde's comments at the ECB's Central Banks, of course, forum here in Sintra. Now, here in Portugal, she underlined the hawkish stance from the ECB, so we'll have plenty more on that next. This is The Pulse.
It is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached. Bearing a material change to our expectations for inflation, we will continue to increase rates in July.
ECB President Christine Lagarde there speaking at the introductory speech here in Sintra, Portugal, just minutes ago. Now, here with me, Bloomberg's Jana Randa, who covers the ECB for us. What you don't know is that she briefs me every morning just so that I have the right topics that we need to grill our guests on. Look, Christine Lagarde was sounding quite hawkish. What does that mean for a September hike from the ECB?
Well, she had a little preface to her speech which said she wasn't going to give any policy message, so we shouldn't infer from right. But she did sound very hawkish. She said inflation was much too high for comfort and has been for much too long. Which means that one comment that I found remarkable is she said we cannot say with full confidence that in the near term that interest rates have reached a peak. So that tells you a little something. She didn't mention September, but clearly there is a lot of concern about inflation being too high, about it not coming down as quickly as policymakers want. And she had quite some messages saying inflation expectations need to be anchored. She said companies need to absorb some of the wage pressures we've seen in their margins to make sure that demand is coming down and that inflation actually can come down as well.
But yeah, I mean, there are two things, right? So first of all, is the hike, so where we reach peak rates, and then how long they'll stay there for. The market believes there's some kind of cuts coming next year, and she really pushed back against that.
Yeah, exactly. I mean, the policymakers at the ECB are very, very concerned that somehow there is this idea they reach peak rates, they hold for 2 months, and then they cut again because inflation is coming down, and they're really pushing back against that. Inflation, if you look at the forecast, it's expected to remain stubborn. It's coming down only slowly in the projections, and if you want to keep on that trajectory, they believe they need to keep restrictive levels for longer. And in fact, we had Martin Kazaks, the Latvian central bank governor, on this morning, and he told you that no rate cuts in the first half of next year. So that's as blunt as it can get, really. We don't even know when we will reach the peak. Once we're there, don't bet on cuts. So that is really the message they want to drive home, and that is to anchor inflation expectations and make sure that we're not getting into a worse situation than we already are in.
Yeah, he seemed to believe that actually lesser of two evils is over hike. Thank you so much, Jana Randau, there from our ECB team. Now, as our coverage, of course, continues from Sintra, in a short while, we'll be talking to the Lithuanian central bank governor. And then a little bit later today, we're joined by the Slovenian central bank governor. In between, I think we speak to Gita Gopinath, a deputy, also managing director of the IMF. And then tomorrow, we continue our coverage with an exclusive interview with the ECB vice president, Luis de Guindos. This is The Pulse.